Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Dear viewers, hope you are doing fine. In the post-COVID rally, a multitude of IPOs saw the light of the day. Thousands of demat accounts were opened as retail investors wanted to participate in the emerging new businesses amid post-COVID rally. Now, many of these businesses listed at decent premiums to the issue price. Our view on most of these IPOs was a void. We believe that it was an unpalatable proposition given the fundamentals and valuations. As Warren Buffett says, it's almost a mathematical impossibility to imagine that out of the thousands of things for sale on a given day, the most attractively priced is the one being sold by a knowledgeable seller, that is company insiders, to a less knowledgeable buyer, that is retail investors. I totally subscribe to that view. Now, with the interest rate rising and cheap money getting scarcer, the IPO activity has been muted. Many of these IPOs have corrected sharply, and yet they do not look attractive from an investment perspective. In today's video, I am going to cover a different kind of offer through which companies raise money. The investors who pay the money in return for a stake in the company are a lot more experienced and sophisticated than the retail investors. And keeping a track of activity on this front could be a starting point to discover some gems in the market. I'm speaking of QIBs and QIPs, that is qualified institutional placement and qualified institutional buyers. Towards the end of the video, I'll share some stocks that are currently available at a discount to what the sophisticated investors paid for them. But before we move to that, let us understand what QIP is. Well, QIP or qualified institutional placement is a fundraising mechanism. Herein, a company which is already listed on exchanges raises capital from the domestic markets by issuing equity shares or securities such as debentures that could be converted into equity. Now, QIPs were allowed and introduced by regulators so that Indian companies do not have to depend too much on foreign money through the issue of global or American depository receipts whenever they needed to raise money. Now, unlike an IPO, the people who participate in this offer is not general public. The only parties eligible to purchase is a select group of persons called qualified institutional buyers or QIBs. These are accredited institutional investors as defined by the market regulator. So why would a company choose to go via QIP instead of, let's say, raising money through an FPO or follow public offer? Well, QIPs is a quick way to raise capital whenever a company needs external funds for growth and for running the business. In comparison, other modes of raising funds such as FPO could be time-consuming, costly, and may require a lot of procedures and guidelines to be followed. As for QIP investors, they may choose to invest this way as they are likely to get a stake at a discount under QIP as against buying shares in the open market. The maximum discount that the regulator allows is 5% on the floor price of the issue. The floor price itself is decided as per a pricing formula that takes into consideration average weekly highs and lows preceding in 2 weeks and 6 weeks of the relevant date. Now, as a retail investor, you should keep in mind that QIP will lead to increased base of equity shares and to that extent could lead to some earnings dilution. While following QIBs does not guarantee a gain, since the investors are experienced and sophisticated, a good demand of QIP suggests that they see value in the business at QIP issue price. One can assess this demand from the discount or premium offered on the QIP from the floor price. If the discount is huge, it suggests a weak demand. On the other hand, if there is a premium, it suggests confidence of institutional buyers at a given price in the business. This does not mean that you should blindly follow the investors and buy such stocks, but it can indeed be a good point to start selecting stocks, especially in a scenario when markets correct. If you indeed find a stock that looks good on fundamentals, there is a chance that you could enter these stocks at a price lower than what FI is paid during market down cycles. Now, moving on to the stock bit. While there are quite a few companies that have raised money through QIPs in the last 2 years, in this slide I have shortlisted the names where the current stock price is lower than the price paid by the QIPs and where the fundamentals look comfortable. I have avoided companies with high pledging and debt. Now, please note that a negative number in the fifth column suggests a discount from the floor price, that is weak demand for QIP, while a positive number suggests a premium. Now, please do not take this as a buy or sell suggestion. Like I said, this is just a tool or starting point and not the substitute of research. If you find this content interesting, do like the video and let me know in the comments section. For more such investing insights, subscribe to Equitymaster YouTube channel. Thank you for watching. Goodbye.